Hey everyone, welcome back to Stock Chart Analyst for another weekly big picture update. If you're getting value from these videos, hit subscribe, tap like, and turn on notifications so you don't miss the key setups we're tracking. Let's jump straight in, starting with the SPY. This week is stacked. We've got CPI, PPI, jobless claims, the start of major earnings season, and now the Supreme Court has delayed its ruling into this week, landing right in the middle of these major data releases. So yes, macro risk is elevated. Yes, headlines are stacking up. And yet, the market just printed another all-time high. That's important. This price action is not showing fear, it's not showing panic, and it's not behaving like a market bracing for bad news. In fact, it's acting as if it expects favorable outcomes. Last month's CPI came in very cool, well below expectations. If we get another print like that, we're no longer talking about a one-off, we're talking about a trend, and trends are what the market trades. Technically, I still see no topping behavior, no structural breakdowns, no major distribution, no aggressive rejection. So for now, there is no reason to trim early. I'm comfortable letting price continue higher, and this still aligns with a wave 5 extension target around $741. Bottom line, the market looks strong, the chart looks healthy, and until that changes, I'm letting it run. Now let's move to the Qs. This is where things get interesting. We're seeing classic bullish wedge structure, and price is now pressing into the breakout zone. That level was tested twice this week. It hasn't fully flipped to support yet, but it's close, and the structure remains constructive. We've also been watching the 50-day moving average, and in my view, that level has now been reclaimed and held as support. That's a big technical shift, and the Supreme Court delay helped the week finish strong. And although their ruling may come Wednesday, the market is not pricing this as bearish. Volatility is not spiking. Risk appetite remains intact. Again, that tells us something. This type of wedge structure with repeated breakout tests usually suggests pressure building, not exhaustion, which supports our thesis. A final aggressive rally is still in play. Structurally, that aligns with our wave 5 target near $722. So once again, I see no reason to sell into strength early. This setup deserves respect. Let the chart do the work. Earnings season zooming out. This is also the start of a critical earnings window. We're seeing reports across financials, consumer names, industrials, and early signals from tech and growth leaders. Earnings will either validate this rally or start to challenge the narrative. What the market wants: stable margins, resilient consumer demand, and guidance that doesn't signal slowdown. Pay attention not just to beats and misses, but to forward guidance and tone. That's where the real signal is. Macro and economic calendar. This week is a collision of data and policy. We have inflation, labor, housing, manufacturing, and a wall of Fed speakers all at once. This week will shape rate expectations and risk appetite. Monday, Fed Bostic in the evening, then Fed Williams late. Williams is highly influential, so tone matters. Tuesday, the main event, ADP employment, then CPI and core CPI at 1:30 p.m. ET, hot print. Yields up, stocks down, cool print. Yields down, risk assets rally. We also get new home sales and comments from Fed Barkin, Wednesday mortgage data, PPI, retail sales, existing home sales, business inventories, plus Bostic, Kashkari, and Williams again. Kashkari is usually hawkish, so any shift in tone will be watched closely. Thursday, jobless claims, Empire State, Philly Fed, Fed Bar, Barkin again, and the Fed balance sheet update, which directly impacts liquidity. Friday, industrial production and capacity utilization, hard data on demand and output. Big picture. So zooming out, this is a narrative shaping week. Inflation, labor health, consumer strength, and manufacturing momentum all collide, while Fed officials flood the airwaves. Expect yield volatility, fast sector rotation, and rapid narrative shifts. But here's the key point. Despite all of this, the market is acting strong, the charts are constructive, and price is still pushing higher. So until the data proves otherwise, the trend remains your friend. That's the full breakdown for this week. If you found this useful, hit like and subscribe. And as always, we let the charts lead, not the headlines. See you in the next one.